How much, and can you talk about the mechanism in which the two rate cuts will affect the real economy, and how much, to what extent will it offset the negative effects of the trade uncertainty and tensions?
So in terms of how our rate cuts will affect the real economy, first, we think monetary policy works with as Friedman said, long and variable lags. So I think the real effects will be felt over time. But, we think that lower interest rates will reduce interest burden for borrowers so that interest-sensitive things like housing and durable goods and other things like that, cars, it supports purchases of those. Just, again, broadly more accommodative financial conditions, higher asset prices. That's the models and the data show that that's another powerful channel. I also think there's a confidence channel. You see household and business confidence turn up when financial conditions become more accommodative. So I think through all of those channels, monetary policy works. It isn't, precisely the right tool for every single possible negative thing that can happen to the economy. But nonetheless, it broadly works. And, we're going to use the tool we have. And if it comes to it, we'll use all of our tools. So that's how we think it works and how we think it's working.
And how much will offset the trade impact?
It's very hard to say. It's tough to say. We'll use our tools to offset negative. That's really the job of monetary policy, is to the extent it can to offset things that drive us away from maximum employment and stable prices.
And Nancy Marshall-Genzer with Marketplace. Chair Powell, are you worried that the low interest rates are adding to or could create a bubble of consumer and corporate debt that could make it more difficult for especially consumers to recover from the next recession or survive the next recession?
So if you actually look at households, households are in very strong shape. They're less levered. They've got less debt. They've got more income relative to their interest requirements, and that they're in very good shape, much better shape than they were in before the financial crisis. So the household sector, as a sort of aggregate matter, is in very good shape. That doesn't mean that every single person in the household sector is in good shape, but overall, it's really not a concern. The business sector is something that we've talked about a lot and studied a lot, and the situation there is that the level of debt relative to GDP in the business sector is at a high level. However, so is the size of the business sector. So actually, the business sector itself is not materially higher leverage than it was. Nonetheless, there are a lot of highly levered companies, and that's the kind of thing that happens during a long cycle when there aren't downturns. For now into our 11th year, you do get that kind of phenomenon in a long cycle. So that's something we're monitoring, and I think our view still is that's a real issue, but what it really represents is a potential amplifier of a macroeconomic downturn. It does not have the makings of anything that would undermine the workings of the financial system, for example, or itself create a shock that would turn the economy down. It's more of an amplifier. We take it very seriously, though, and we're monitoring it carefully. We're actually looking. The Federal Financial Stability Board is actually conducting a project right now to identify where these loans are held all around the world. So it's a subject of a lot of study and work, and we're trying to keep on top of it.